Good afternoon to everybody and welcome to today's virtual Adding Value Post-COVID panel. For those of you who don't know me yet, my name is Martin Henrichs. I'm running Healthcare Investment Banking EMEA for UBS and will be the chairs of today's panel. We have the privilege of having three prominent investors with us today, Xavier Cheval from Icade Santé, Ravi Umarji from TPG, and Tobias Küng from EQT Infrastructure. All of them have a strong interest and track record in healthcare services. Each of them are looking at healthcare services from a different angle, be it with a private equity, a real estate, or an infrastructure head-on. And these different viewpoints on the same sector should therefore ensure that we will have a very interesting debate today. The way that this panel is structured is that we will start with a short intro of all our panel participants. We will then have a lively debate among ourselves. I will then open it up to Q&As for all of you. So please submit your questions you would like to ask to our panelists via Zoom, and we will then share them. In between, we will also hold audience polls. And following the investor panel today, as Lee was already alluding to, you will also have the opportunity to continue the discussions and share your own experiences in a roundtable discussion. This will run from 3 to 3:30 p.m. UK time on the topic of healthcare M&A landscape. Let me now hand it over to Xavier, Tobias, and Ravi for a brief intro. I would suggest we start with you, Xavier, and then Tobias, and then Ravi. Over to you, Xavier.
Good afternoon. So my name is Xavier Cheval. I'm a 37 years old French, and I'm the head of the healthcare property investment division at Icade. Icade is a French listed REIT. The business I'm heading, I've been involved in that business for the past 13 years, and it holds nowadays a bit above 5.3 billion euros in healthcare real estate assets. So the purpose of our company is to basically partner with healthcare operators, with nursing home operators, and to build a portfolio that yields a consistent cash flow based on that real estate. We are now in the middle of a strong investment plan to build one of the leading healthcare real estate platform in Europe. So our base is in France, but we are now investing also in Germany and Italy. So just to introduce myself quickly, and we'll come back to a few questions later on.
Great, thank you very much, Xavier. Tobias?
Great, very happy. Good afternoon, everyone. My name is Tobias Küng. I'm a managing director at EQT Infrastructure. To give you a bit of color on EQT Infrastructure, we're currently in fundraising for our fifth fund. Target size is 12.5 billion and hard cap of 15 billion. And my role, I'm leading social infrastructure in continental Europe. What is social infrastructure is basically healthcare services and education. I think important for everyone, healthcare is a big focus of EQT actually across all the funds. Since the inception of EQT, we've invested more than 40 billion euros enterprise value in healthcare, invested in all subsectors, so pharma, medtech, and healthcare services. Myself, I've been involved in Charleston, a German elderly care home platform that we sold end of last year, and also involved in Colisée, the fourth largest player in Europe, which we have recently acquired, where we're currently working towards closing. CDPQ Infrastructure is partnering up with us on this, and we've also recently successfully placed the acquisition financing for this at very attractive terms. Very much looking forward to the discussion.
Great, thank you, Tobias. Ravi?
Hi, everyone. Delighted to be here. My name is Ravi Umarji. I'm at TPG Capital. I've spent the last 8 years of my career with TPG focused exclusively on healthcare. And healthcare has been among TPG's largest and most active sectors. And on the basis of that activity, we've raised a dedicated fund, the first of its kind, focused on large cap healthcare private equity deals. About 2 weeks ago, I moved to London, so amidst the pandemic, and as part of our effort to extend our activity in the US into European healthcare investment. So I'm delighted to be here, and we can discuss the rest during the question period.
Great. Thank you, Ravi. So let me maybe start with the questions. And my first question goes to Xavier. Xavier, you own 150 healthcare facilities in Europe with a property value well in excess of 5 billion euros, as you mentioned. What has been the COVID-19 impact on your portfolio, and in how far has the pandemic changed the way you look at investments?
So I would say, in a word, healthcare real estate has proven to be very resilient in the recent past and over the COVID crisis, and mostly thanks to massive support from the French and the European governments. I mean, most of our portfolio is French, so I mentioned French government first. In fact, COVID-19 has put an enormous pressure and many responsibilities on the healthcare operators' shoulders. And the healthcare operators are our tenants. So we have seen in early spring a very rapid shift in the production of our tenants, and basically 70% of their normal turnover in acute care has turned to zero. So in a move to compensate the operators for that, the governments have provided, especially in France, they have provided a very strong financial support to the healthcare providers. So our tenant base, they received a support based on 2019 figures from the Social Security, meaning that 90% of their normal activity in terms of turnover will be paid until the end of year 2020. So it's a very massive and strong support, and we are a provider for these healthcare operators, real estate provider. So for us, it means that basically our tenants do not face or only limited operating losses. So they are in a position to pay for their rents. So COVID-19 end up with our rents are being paid. So I would say it's quite a good outcome for us. Having said that, I mean, in nursing home space, it's a bit different, but it remains also very solid because most of the nursing home operators, they have locked down their facilities, but they have kept their people and their residents in the facilities. So they have maintained most of their turnover, and once again, they do not face only limited operating losses. So that's part of the outcomes from COVID-19 for us. Well, looking ahead, that's the second part of your question. We monitor closely what the second wave will be, the second wave of the COVID-19. We are right in the middle of it, especially in France, where the virus is quite strong at the moment. But what I can say is that we have learned a lot from the past, and I would say we are ready to face this second wave, and our tenants are also ready to face the second wave. So I think that the resilience that we have seen in the first semester we remained valid in the second semester. We are also seeing that on the investment side, we are seeing capital inflows in the market because many investors are looking for safe havens. And probably healthcare, and we'll talk about that later, but healthcare is seen as a safe place to put money in. So we are dedicated investor for a long time on our side, but we are seeing maybe new investors coming in the short term. So that's for the investment side.
Yeah, thank you. Very interesting, Xavier. Tobias, among the infrastructure funds, EQT Infrastructure and yourself have been at the forefront of investing in healthcare with, as you mentioned, the former Charleston long-term care investment in Germany, and most recently the Colisée Patrimoine investment. In how far has COVID-19 changed the way you look at investments, both in terms of healthcare subsectors, but also countries you would consider for an investment?
Thank you for the question, Martin. I think, first of all, it's important to understand how we generally think about investments from the infrastructure side. What we look for is really resilience, essential service, resistance to downturn, barriers to entry in businesses, market leadership, and also sufficient value creation. And this is also the case when we actually look at investments in the healthcare space. This has not really changed through the current COVID situation. What I actually think is that the current crisis shows again the relevance of the healthcare sector overall, and also the attraction and the essentialness of this sector. What I would say for us, what may have changed, or will we even have a closer look also in terms of subsector, that we look at it in a way, how essential is the service that is being provided. To give you an example from our perspective, so elderly care homes, I think they show a very high degree of essential service from our perspective. There's not real alternatives to it in the end. So as a result, they also benefit from better protection versus maybe other subsectors. I would also say that hospitals, depending a bit how many electives you have as a hospital, but also on the labs space, which now prove quite fundamental and essential to the system in this crisis, they may benefit a little bit of that. Besides that, bit less relevant now for us, but in general is also the online-based services, which gained quite a lot. I think in the pharmacy space you see that, but also at telehealth that benefited quite a bit. And I think also important to mention is that the current situation will also offer quite a lot of opportunities from our perspective. I think there will be some in-sector consolidation as opportunities arise overall. In terms of countries, your second part of the question, our focus has not shifted. We analyze countries in detail, how they have reacted, how they have dealt and also supported healthcare providers. I think Germany has probably done pretty well overall so far, but also has been a focus country before already. I think the same also holds true for Switzerland or France. And in Spain or in Italy, I think there will also be quite some opportunities due to the crisis, just to mention a few.
Right. Thank you, Tobias, for these perspectives. And Ravi, similar question to you as Tobias. In how far has COVID-19 changed the way you look at healthcare investments in terms of services, subsectors, and countries you find attractive for investments?
Thanks for the question. I want to tie together something that Xavier said and something that Tobias said, which is that, healthcare has been extraordinarily resilient, has demonstrated its value to society and to the economy. And as we think about investing at TPG, we think about it over a long-term, multi-year, thesis-driven thematic context. And so, to give you a little context, we have done 2 deals since COVID hit. And similarly, one of our most successful deals in IMS Health during the great financial crisis. And the reason I bring up those examples is that the commonality is a focus on investments where we have a deep thematic view that we've explored over years, driven by relationships we've cultivated over time. And that has allowed us to execute in a time of uncertainty. The resilience of healthcare allows you to do that. And I think in this case, one of the things that COVID-19 has done is it's emphasized trends or underscored trends that we had already observed that are continuing, in some cases accelerating, whether it's the shift out of institutional sites of care like short-term hospitals home or lower acuity sites of care, whether it's the need for really strong behavioral health provision, particularly on the outpatient side, whether it's the need for cutting edge pharma and innovative supply chain to make sure that those pharma drugs get to the patient in a secure, effective way. All of those things have only increased in importance due to COVID. And these are things that we were focused on prior to the pandemic. I think clearly, COVID-19 is important to think about in terms of near-term cash flow, in terms of pricing, but the overall thematic orientation hasn't really changed. And I think similarly to what Tobias said, in terms of countries that we're focused on, each country has its own different idiosyncrasies in terms of the regulatory framework, how they've responded to the crisis, and what that means for different subsectors. That country by country analysis within Europe was already going to need to be analyzed prior to the pandemic.
Yep, great, thank you. This is the time to do our first poll, and hand it over to Lee to ask the first question to the audience. So what do you predict will happen to valuations in the next 3 months compared to the pre-pandemic levels? Do you think valuations will increase or decrease? So please vote now, and we will then see the results later on. Let me, in the meantime, continue with the next question for Xavier. So, Xavier, how do you look at financial returns and holding periods compared to private equity or infrastructure funds?
So we are long-term investors. So we do not consider basically selling our portfolio in a short, medium, or long term. Of course, we consider liquidity at some point, because that's also part of financial flexibility. But it's a buy and hold strategy, and we do not have a asset rotation strategy. So having said that, what we do invest in are, as I said earlier, cash yielding assets, real estate assets. We have a target that is in line with local markets. So in France, for healthcare assets and in real estate, you will find yields, net yields around, between mid-4 to 6%, something like that, depending on the characteristics of the assets. It's close to that in Germany. It's a bit in the higher end of that in Southern Europe. And investing in such assets, we expect with a reasonable financial leverage to get 7 to 8% return on equity. So that's before taking into account what may come into place, that is cap compression. So of course, if all the cap rates are going down, our stock is a bit. What we hold, our holdings do value higher, but we expect a 7 to 8% return on equity. That's our target. So as you can understand, we are rather a dividend yield player rather than a value creation. That's from a financial perspective, because we have a portfolio that is fully rented. There's limited space to increase rental values, like you can have what you can have in office, in the office real estate, for instance, or commercial real estate, where you can expect. You used to expect increase in rental value, but in healthcare real estate, that's not the case. So we rent assets for a long period of time. We expect sustainable cash flows, and to some extent we get value creation, but that's not at the core of our strategy. Also, we of course consider to invest with our tenants to develop or to expand assets when it's necessary to fuel organic growth on a specific facility. But the core of the strategy is to have this yielding assets in the mid-single digits net yield.
Great, thanks, Xavier. Let us check whether the results of the poll are already available. Here they are. So interesting to see that roughly 44% of you expect the valuation levels to roughly remain the same, while those of you who think they are higher or lower are actually equally split. So that's an interesting finding. Let me continue the questions, and another question for Tobias. So how do you look at financial returns compared to traditional private equity funds, bearing in mind that EQT also has a very large EQT private equity fund? And are your return requirements lower than traditional PE return requirements, which is a question I often get?
Thank you. Very happy to answer this. I think, first of all, we don't require a cash yield for our infrastructure strategy, and we do not pay dividends. Usually, we are really very much focused on reinvesting into the business, allowing them to reach their full potential through that. Our target return, to give you a bit of an idea, on average, they're somewhere mid-teen. They're adjusted on a case-by-case basis, depending on the perceived risk of an investment. So they are probably slightly lower than what regular P is using, which is presumably more in the 20% range.
Okay, great. One slightly different question to Ravi. So, as you just mentioned, you have spent 8 years at TPG in San Francisco before just moving to London. What are the fundamental differences between doing private equity in the US and doing private equity in Europe?
Thanks. And maybe I can start by talking about the similarities before talking about the differences quickly. So to head it off, we view the European investment landscape as an extension of our US efforts. And there are a lot of themes and approaches that overlap between the two geographies. So to run through a few of them: aging population, escalating costs, and the need to increase efficiency, as well as the need for innovative therapeutics that can treat chronic diseases more effectively, more cheaply, and in a clinically appropriate way. And as societies manage their healthcare infrastructure, they'll continue to focus on these themes, which have been the underpinnings of many of our investments over time, both in the US and some of the recent ones in Europe, which I can talk through. But those themes, regardless of geographic context, will guide our investing. So whether it's innovative manufacturers like BVI and the Belgium-based IOL manufacturer we folded into it a few years ago called Physiol, whether it's Kindred at Home, which does home-based care, which is lower acuity, those types of investments based on the themes I described, they really do transcend geographic borders, and I think will drive the focus areas we have here. I think the other thing to point out is that, I think everyone here appreciates this, is that there's no monolithic one European market. There are 30 more or more, depending on how you count it. And so every investment we do requires a deep analysis of the regulatory and competitive landscape within each country, which frankly is something we do in all of our healthcare investments no matter what, because the regulatory aspect and the competitive aspect is so unique to the sector and the specific instance. And so the one thing that you notice in Europe is that you've got many different countries with different local champions, where in certain subsectors you might be earlier stage in consolidation relative to the United States, because that's one large integrated market. But those local champions now are starting to think through whether a pan-European consolidation strategy might make sense. That could be fertile ground for investment from a private equity perspective.
Okay, great. Before we move into the second poll, maybe one question to all three of you, very brief answer. Do you experience the same as we have seen here in the poll, you expect that valuation levels are going to say roughly the same, or do you expect an increase or a decrease in valuations? And maybe we stay with you, Ravi, first, and then Xavier and Tobias can also answer from their perspective.
I would probably generally agree that valuation levels are going to be roughly in the same ballpark. The only nuance to think through is once we're through COVID and the uncertainty is removed, in certain geographies, various central banks have committed to keeping interest rates low, which just theoretically and analytically results in higher valuation levels. And so that would be the only reason I might have some instinct that there could be an uptick, particularly after we're through the crisis, because many banks have said they're going to keep rates low for quite some time. But outside of that nuance, I think I'd probably agree with the respondents in the audience here.
And you, Tobias, what is your view and experience?
For me, I would probably speak mostly for healthcare services now, not general healthcare, and even there, it depends a bit. I also tend to agree that they will remain the same. If you probably look at multiples for 2021 EBITDA, I think most of the factors already priced in at the moment. So nothing to add in addition from my end to that.
And Xavier, do you share that experience in your market?
So in my market, first, probably the EBITDA from a real estate investor perspective is something that is less tricky to determine, because a rent is something that is quite clear from the beginning. So based on rent, if you look at yields, also there are not so many transactions. I would expect either the yields to remain as they were before the crisis, or to decrease a bit, meaning that the valuation might get a bit higher. That's my expectation, and that's mostly because real estate at current debt yields level is seen as something that is quite interesting from a financial perspective, with some leverage, and the subsector healthcare real estate is seen as something that is resilient and safe. So I will not bet on a decrease in valuation.
Mm-hmm. Yeah. Okay. We hear you loud and clear. We can move now to the second poll that we have. So which sectors do you think are currently the most attractive to invest in? And you've actually got 10 different choices here. So please go through the list of subsectors, and then please post your vote, and we will look at what the audience thinks are the most attractive subsectors. Great. So let's continue with you, Xavier. When comparing the healthcare services sectors in your home market, France, and the rest of Europe, where do you see the fundamental differences from your investment perspective?
So I would say our core market, so it's France. It's where we have a bit above 90% of our holdings. The French healthcare market is heavily regulated on the operating side. So I would say that's probably the main difference. Overall, it's a strongly regulated market when we consider healthcare sector compared to other markets. But in France, it's particularly heavily regulated. So in nursing homes, for instance, or it's the same for hospitals, it's not possible to open new facilities at the moment, and it hasn't been possible to open new facilities for the past decade. Only in a very limited number of situations there are new authorization granted to operators. So that's a first thing. So the barriers for entry are very high. A second difference is probably when you look at the way the market is financed. and the way the beneficiaries, so the patients in the hospital care and the residents in the nursing home space are funded. In private hospitals in France, basically, if you're a patient, you get paid the same way by the Social Security. So there is no difference for you if you go to a public hospital or if you go to a private hospital. And that's a key difference, because all the market on the operating side has been built on that. And if you look at surgery, for instance, 50% of the surgery in France is provided by the private for-profit sector. Because from the payer perspective, so from the Social Security perspective, they pay through the same scheme the patients. Everyone is eligible in France, so every French citizen get paid for a surgery, and it's cheaper to send people to the private for-profit sector. So the private for-profit sector has known a big growth. I mean, from inception, is now a large chunk of the market. So that's a key difference, and I know from my roadshow perspective, when I meet investors from foreign countries, that's something I need to explain, because they always expect the private for-profit sector to be a niche market within the hospital care market. That's not the case in France compared to what it can be in other countries. So that's a key difference, I would say.
Okay, great. One question to Tobias. How do you think an infrastructure fund can add value to a healthcare services company?
Yes, it's a very good question, I think. So our key value creation levers that we usually apply together with management for companies that we acquire, I think mostly on the operational side, operational value creation, but also very much on the growth end. We have in several instances focused a lot also on M&A strategies. I think also our governance setup helps quite a bit with industrialists in the board. Then I think digitalization over the recent years have also seen quite a lot of importance, and also the ESG and sustainability topic that EQT supports a lot, and where we like to also apply that knowledge or develop that in companies that we acquire. What we in the end try to do is sort of future-proofing companies. I would not say that this is necessarily totally different compared to what our PE colleagues do now. I can compare that within EQT. So the thing that may also differentiate us in the end a little bit, we talked about returns earlier, but I think also the holding period, we have more flexibility on that compared to a classical PE fund. Our target holding period is probably 5 to 7 years, can also be longer. This gives us a bit more optionality how to grow. If you think about facility-based subsectors, where sometimes it takes time to do new builds, so that's something that may be easier for us.
Okay, thank you, Tobias. Can we check whether we've now got the result of our second poll? So interesting to see that telehealth seems to be the clear winner. 65% of you in the audience think that this is the sector of the future. But also interesting to observe that elderly care and laboratories make the cut above 1/3. So that's I think an interesting one. What surprises me a bit personally is that dentistry and pharmacies only have single-digit percentages. So that's an interesting finding. Before we move to our third poll, I would have one question for you, Ravi. So how do you compete against Tobias and Xavier, against infrastructure funds, lower return funds and REITs, given their lower return requirements compared to traditional private equity funds like yourselves?
It's a good question. I think there are sort of a couple ways to think about that. The first is sort of where we are focused is areas where we have a long-term view, can hold a company for a long period of time, and ideally build it up and execute different transformational investments. So as an example, a large M&A deal post-close or an operational investment to maximize efficiency. And I think there are certain areas where that will be beneficial for us and where we think we'll have a good opportunity in a space we like to partner with management, and we will pursue those.
Great. Can we now do our last poll? So when do you expect the deal flow volume to return to pre-pandemic levels? Is it Q4 of this year, i.e. now, or is this in one of the subsequent quarters or even later? So can you please all vote, and then we will see the results. It will be an interesting finding.
Especially for you, Martin, from a M&A bank perspective.
Absolutely. So let me continue with one question that I would actually like to ask all three of you with a request for a short answer. Let me again start with you, Xavier. So how do you price transactions in the current environment where neither company earnings nor transaction multiples or yields are normal?
So we try basically to take a stand and a long-term view based on the historical figures, and we try to set, as always, the rental value based on these operational figures. So what the tenant is able to operate and to produce. And then we get hopefully a buffer that is good enough to have a sustainable rent over a long period of time. What is probably a bit different nowadays is that we look closer at the ability for a tenant to cope with a pandemic risk, meaning that is the building ready to separate flows, for instance? Can you accommodate with a lockdown? And from a financial perspective, has the tenant sufficient buffers on its balance sheet to pay for the rent and to sustain a hit? So that's a bit new.
Same question to you, Tobias. How do you price transactions in the current pandemic?
Yes. So for us, usually we price cash flow based. So we don't have a purely multiple focused approach. We form our view how long we hold the asset, what the exit valuation could be like, and how the business plan looks like until then. And that's basically how we derive the entry valuation, and then results in a implied entry multiple. We obviously also look at different cases to see how sensitive the case is, what happens in case there is a corona situation which lasts for 2-3 years. What happens if there's a vaccination soon that is efficient? What if not? And then calibrate the end result.
And to repeat the question for Ravi, how do you price transactions in the current COVID environment where neither company earnings nor transaction multiples or yields are normal, in quotation marks?
Right. So recall, we have a long-term hold strategy. And so the first step is to establish a view of normalized earnings, normalized growth, and then what we think an asset like that should trade at our ultimate exit at some point in the future when COVID is not present. And that allows you to calibrate to what the right type of multiple might be to enter at, given those other facts. And the temporary disruption of COVID might provide an opportunity for a more attractive entry. or might provide something we need to think about in terms of initial capitalization of the balance sheet, which is obviously an upfront use of funds in our transaction.
Great. So let's see whether we have the result of our third poll, whether it's ready already. So here we go. So interesting to see. It's relatively split between deal volumes coming back Q2, Q3, Q4. So it's difficult to really distinguish. So pretty dispersed view here among the audience. I will soon open it up to Q&As. I just would like to ask one final provocative question to each of you on this panel, and with the request for a short answer, please. So Ravi, given that I see you, if you could swap fund with any of the other panelists, who would this be and why?
Wow, I was not expecting that question. I'll try and be brief. I would probably go with Tobias, because I think on the infrastructure side, there's a bunch of interesting sort of strategies, and many of the things he described are not so different from some of the private equity strategies, so there may be a bit of overlap.
So Tobias, not that you're forced to move at all, but if you could swap fund with any of the others, who would this be?
Well, actually, I'm pretty happy where I'm currently am, but very hypothetically, I would probably then swap with Ravi.
Oh, yeah, perfect. So we've got a swap couple then. That is good.
Yeah, exactly.
I should have started with that also, which is I'm very happy where I am, which I'm sure goes without saying.
Great. And you, Xavier?
Well, I think my positioning is a bit different. So I'm also quite happy with my current situation, and I think that there's a lot to do in healthcare real estate. So I'm happy to have the kind of relationships that I have currently with our tenants and to partner with them as a real estate player.
Great. So let me now turn it to the audience, and we got a few questions coming through. So one question that comes through from Jose Roja is, what's your view on investments in primary care in Europe? Is there real money to be made through consolidation of the segment, or is the segment inherently fragmented and difficult, impossible to consolidate? Does anybody have a particular view on this? Anybody who volunteers?
Yeah, I'll take a stab at it. My instinct is that there should be a consolidation opportunity, particularly within certain geographies and certain subsectors. There are two challenges. One is the attitude of the current owners towards an institutional investor coming in with institutional capital. And the second is, in certain countries and certain geographies, there are regulatory barriers to entry and consolidation. But in places where you can overcome the first and the second issue doesn't apply, you should have some gains to consolidation, and there should be a way to align the incentives to overcome the first. So cautiously optimistic is sort of how I describe it.
Great.
If I can add on that, I think there is room for improvement and for gains for operators. If I think of the French situation, I mean, everything is about how you manage from a geographical perspective the way people are treated. So you have the first recourse close to your home, and then something that is heavier in terms of technical facilities and so on in larger cities. And if you consolidate the market, if you're able to do that as an operator, I think you will get synergies, you will get gains, and you will be able to add to regular healthcare services, some other services, how you improve a patient's life, quality of life, etc. So I think there is a lot to do from that perspective, and that's also how we look at that as real estate owners, because we build and we invest at a different scale depending on this geographical strategy.
Yeah, not a lot to add from my side on it. I think I also agree with Ravi. I think on the doctors, that it depends a bit how easy it is to basically bring them into a larger group. What we've been debating quite a bit as well is from time to time also the synergies that you can really realize. In the end, it's maybe a bit tougher to grasp compared to other sectors, is a bit my feeling.
Okay, thank you for that. There's an interesting question from Suresh coming through. He says, it's interesting that the focus is still in Europe and the US when the opportunity is tremendous in Asia, where you have 40% of the world's population and a wealthy segment now where there is an enormous demand for infrastructure and healthcare services. Maybe I start with you, Ravi, given the global nature of TPG. How would you comment on this?
Yeah, so we do a lot of healthcare investing in Asia and Asia Pacific region. It just happens to sit out of our Asia fund. So where our healthcare fund is focused on developed markets like Western Europe, broader Europe, and the US, our healthcare investing in Asia sits in a separate part of the firm. And of course, many times what will happen is I might come across an opportunity in Asia that's really interesting. And members of the team, either in the US or in the US and Europe, will attach themselves to the deal team that's prosecuting it in Asia to make sure that the learnings are shared. Because while the regulatory context is important, the themes we've been talking about are persistent across geographies in many ways.
Maybe Lee, do you also want to comment on this, given that HBI has an important presence outside of Europe?
Hi, Martin. Thank you for putting me on the spot there. Yeah, I think there's a huge amount of discussion around that. I mean, the reason, Suresh, probably that this is tailored towards Europe and the US is given the nature of the panel and sort of the focus. It's actually quite an interesting segue. We have a few sessions coming up on the 18th, 19th, and 20th. Of November, which will talk more detail. We'll look into each region's evaluation. It is really interesting actually to see pandemic response from what's happening in Asia. I was speaking to somebody the other day, and they're talking about, if I look back in my notes, the big impact on private healthcare over there in terms of people utilizing their health financing. What's happening with insurance policies are collapsing. People are lapsing on their policy payments, which is really strangling some of the private providers. So it's interesting for us to really look at that. Maybe we could talk about that a little bit further in the session that we have coming up after this.
Maybe coming back to our three core panelists, one question from Silsa. We saw a lot of interesting technologies, companies, applications being developed post the COVID crisis hit. What has been one of the most interesting technologies, opportunities, subsectors that you saw come out of this crisis? Does anybody have a strong view on this? Anybody who wants to answer that question first?
Well, I can chime in. I mean, I'm not sure that there has been a specific new technology that has been developed in the last 6 months, but I think what you're seeing, and one of the polls that we ran here sort of highlights this, what you're seeing is the adoption of existing technologies with greater acceleration. So I'll provide 2 examples from our portfolio. These are US based, but hopefully provide some illustration. And as we're seeing in Europe, it's not that different, the things I'm about to describe. So in one of our companies in the US, it's a physician group that does primary and specialty care. And they were doing all in-person visits, as most people did prior to COVID. And the amount of virtual visits has structurally changed. And so it peaked, obviously at some level, it came down after the surge subsided, but it's still elevated relative to history, and probably that will continue. You're seeing that in a variety of other applications, by the way, is the shift to virtual, not wholesale, because people still like to see their provider in person, but to some degree more than historically may have been the trend. And then the second thing is the idea that adopting technology that exists maybe to make staffing more efficient, make care coordination more efficient, make reimbursement more efficient, those things which were already happening are more urgent now for providers than they were before, particularly providers that are under any sort of stress, because those things either minimize cost, maximize cash flow, maximize the care delivery to patients, all of which are, you know, of most important at this moment in time.
Yeah, we've seen a similar trends in elderly care, where the virtual connection between the residents and relatives have I think increased quite a bit. It's probably not a extremely new technology, but I think an important development. I would also argue not necessarily a new technology, but obviously a big change is now also on the labs testing side with COVID testing and with antibody testing. And the last piece I think is also on for online pharmacies, that this has been like a push to accelerate part of the ongoing shift, at least in some countries, where more customers basically try to go that route.
Okay, we've got one last question, given that we're really coming to the end of our session here. It's probably more a question directed to both Ravi and Tobias. What's your perspective on the next phase of some recent in-fashion PE services roll-ups, where there's already high PE capital deployed? The examples mentioned are dentistry and veterinary care. Thinking about attractiveness of exit stories and valuation levels for platforms and bolt-ons.
Yeah. Well, maybe I can start. Despite the dentistry and vet care, probably not the areas where I focused on most. But from my perspective, it very much depends on the consolidation level. First of all, how much you can do in addition, and then also how much international expansion makes sense. I think if there is sufficient room and really have the right platform at work, that is still a highly interesting strategy also for the next exit, the next owner. So I'm still positive on all these type of roll-up stories if you really back the right platform and management team.
Yeah, I don't think I have too much to add to that. I think they remain attractive. Different subsectors might be more or less attractive depending on the room left for consolidation, the degree to which the market remains fragmented. To me, one of the important sort of aspects is, what is the true benefit from the roll-up outside of just buying at a cheaper multiple? What can you do from a best practices perspective to truly improve operations, drive efficiencies, build brand, whatever it might be, and it can depend on the subsector. But I think as a general point, all of those types of sectors should have varying degrees of attractiveness and tailwind, given the significant degree of fragmentation and the increasing need from a patient and customer perspective.
Xavier, any last words on your perspective on roll-up stories in healthcare services in the broader sense?
I would say to add on what has just been said by Ravi and Tobias, fundamentally, this sector is growing faster than the overall economy. So I would expect more opportunities in that space. Not only in subsector, which I don't know correctly, like vet care and dentistry, but in healthcare in general, and in nursing, I mean, in senior care in particular, you will find a lot of opportunities, and because there is a strong need for this kind of services. So I expect a lot to do for us in the coming years.
Indeed. We could probably continue this discussion for another hour or two, but unfortunately, every discussion has to come to an end. So thank you very much to all three of you. I think this has been very insightful. Thank you also to the audience. thank you to Lee and HBI for organizing this, and let me hand it back to Lee.